So Dad, last week we spoke about saving for a deposit faster. This week is going to be about the next step of buying a property, how borrowing works.
That's right, Nicola. So we're going to look at what banks look for when working out how much you can borrow and what type of property you can buy. So there's two key things: it's deposit and your borrowing capacity.
What is borrowing capacity?
So borrowing capacity is a calculation of how much you can borrow depending on your situation. So the three things that get taken into consideration are your income, how much you're earning, your expenses, and what you're spending, and also your liability. So any credit cards, HECS debt, car loans that you might have. So those three variables come into play when working out how much you can borrow.
So how does my income affect what I can borrow?
So depending on your situation, you might be employed casual, for example. So if you're a casual employee, you generally have to be employed 6 months in your current role to be able to borrow any money, first of all. Whereas if you're permanent, you can have a job start today and a bank will use your income from that new job. So if you're permanent part-time or permanent full-time, you only need one pay slip to prove your income. Whereas if you're casual, you need to prove that you've been working in that industry for 6 months.
Because it shows that I'm more stable.
That's the way banks look at income. So and every bank is different in the way they look at income as well. So for example, some banks look at if you're casual, they'll look at your income at 48 weeks instead of 52 weeks because you're not getting paid for holiday pay. Whereas some banks will use your actual pay times by 52.
And the leave and things.
So without leave, yeah. So if you're casual, you don't get any leave. So every bank is different the way they look at your income, which is why there's benefits of going to a broker rather than a bank, because the role of a broker is to look at your situation and work out
which bank is best for you.
Which bank is best for you and where you're going to get the most in your borrowing capacity. Income is basically looking at what you're earning, how you're employed, and assessing what you can borrow based on that.
How would it work if I got bonuses or commissions?
Yeah, good question, Nicola. So again, every bank is different. Some banks might look at your last two bonuses and annualize that figure. So let's just say you got a bonus today and you got a bonus 3 months ago, and you might be getting a bonus every quarter. The banks will annualize that figure and add that as an annual income. Whereas some other banks want to see evidence of your bonuses for the last 2 years. So they want to see that you've been consistently getting bonuses for 2 years. Same with commission. Some banks want to see 12 months of evidence of what commission you're earning, whereas some banks only want to see 3 months evidence of what commission you're earning and will annualize that figure. So your income that we can use really comes down to your situation and which bank is best suited for you.
So if I came to someone like you would be able to tell me which bank would be best for me?
Correct, yep.
What would happen if I was to change careers or change jobs?
Okay, so if you were employed casual and you were to change careers, you would need to be employed 6 months in your new job because it is a new career.
Yeah.
But if you were to change careers and your employment term is permanent, so permanent full-time or part-time, you can actually just still apply for a loan.
The day you get the job.
Depending on which bank, with your first payslip. So with an employment contract confirming what your employment terms are. Changing careers isn't necessarily a bad thing. It's only when you are casual it can work against you and you might need to wait 6 months.
Don't worry, Dad, you're not going to become a grandfather just yet.
I hope not, Nicola.
So what if they took maternity leave for a year? Does that affect their borrowing power and how much they can borrow?
Good question, Nicola. So if someone was planning to have a baby, or someone is pregnant having a baby and they're planning on taking some time off work and taking the first year off and then going back to work, most banks would generally accept their return to work income for servicing because they do know they are going back to work, and they will get a letter from the employer confirming what their income will be when they go back to work. So this isn't available for casual employees.
Only for permanent.
If you're permanent and you have got a full-time job or a part-time job and you are going back to work after maternity leave, banks will generally use that income. But what you do need to take into consideration is the banks also might look at how you will be able to afford your loan in that short term whilst you are taking maternity leave. So they might you might need to have a buffer there of $10,000 or $15,000 to cover your repayments, depending on what your partner's income is in that time that you do have off. So you can still have your borrowing capacity calculated, knowing that you are returning to work, and still use your income even though you're not working. The only thing is, when you do have children, you have an extra dependent to worry about. Your living expenses do go up. So the banks will take into consideration your living expenses. The other thing I mentioned earlier was there's three things the banks look for. It's your income, your living expenses, and your liabilities. So now we can touch on living expenses if you like, Nicola. So if you were to have a dependent like you just mentioned, your living expenses would go up. And the way that that's calculated, The banks need to verify, or a broker will need to verify your living expenses from your bank statements. But banks also have a minimum expense per household, depending on what your income is. So if you're a couple with one child, your living expenses will be higher than if you're just a couple, because there's extra expenses for a child. So they call that the HEMS index, which is known as HEM, which stands for Household Expenditure Measure. So every bank has a minimum HEMS index, which is what a general household would spend. But that needs to be verified against your bank statement. So if you're looking to buy a house, try to get understanding of what the banks will use for HEMS, and try to control your living expenses to be in line with that, which will get you the most borrowing that you potentially can have. So even if you're not spending that much, let's say, for example, HEMS
I'm living
index,
with my family.
or let's just say your HEMS index for a couple is, say, $2,300 per month. If you're only spending $1,800 a month, the banks will still use $2,300 as a minimum expense. So even though you're spending less, the banks will still refer back to that HEMS index as a minimum expense to calculate your borrowing capacity.
So what would it be for someone like me living with my parents still?
That's a different
and
scenario
wanting to get
again.
into the property market.
That's a different scenario again. So if you're living with your parents and you're buying a house to live in, you need to take into consideration what your expenses will be going forward, taking into consideration the council rates, SA water, household running expenses going forward.
Is there any threshold I need to meet, the HEMS index, or not?
No. You don't need to meet minimum expense. It's making sure you don't spend more than what the HEMS index is.
Okay.
To get your increased borrowing capacity. But if you are buying an investment property for your first property rather than a house to live in, and you're living at home with your parents, banks also take into consideration notional rent. What that means is if you were to move out from your parents' house and pay rent, there's an expense they allocate to you. Some banks have zero, some banks have $450 a month, and some banks have $650 a month. So
is it better to go with a bank that has an expense? It's
better to go with a bank that doesn't take into consideration notional rent if you're buying an investment property, because then the higher your expenses are on the bank's calculator, the less you can borrow.
The lower your borrowing capacity.
Yep. So that's called notional rent. So if you are living at home, every bank is different in the way they calculate that. Again, the benefits of using a finance broker.
So would the bank look at all expenses the same or differently?
Everything's looked at a little bit differently. So there's the HEMS index, but then there's also some expenses that sit above HEMS. For example, if you have private health insurance and you're paying $300 per month for private health insurance, that goes above HEMS, because HEMS is pretty much your basic living expenses, and anything extraordinary goes above HEMS.
And the basics would just be bills, food, and necessities like that?
Correct, yep. And general spending, recreation expenses. Let's say if you have a child who's at a private school, that's an extra expense which goes above HEMS index. So you might have that would reduce. That's not a basic expense, and that would reduce your borrowing capacity quite significantly. So things that are extraordinary would go above HEMS. Things that are basic expenses would sit within HEMS. So, for example, if you're buying an investment property and there's strata fees, which you don't know what strata fees are, but we'll go into that later. Strata fees would generally sit above HEMS because it's an extra expense above basic living expenses or basic expenses for a property. So it's important to understand what's basic expenses and what's extraordinary expenses. Other things which you need to take into consideration when you are borrowing money is when a bank potentially does go through your bank statements and they see things in there like gambling. If you're gambling every week and you're spending $200 per week, that doesn't look good against your name.
So they won't favour your borrowing capacity.
Correct. So that's all the other thing is they look for is any other debts you might have. So you might have liabilities that you're paying something back which you haven't declared and it's on your bank statements. So you've got to make sure that you are stating all your expenses when you are applying for a loan.
And you're transparent with the bank to get the most borrowing. So I know a lot of people my age want to travel around Europe for a few months. They're not going to be working during that period and they're going to be spending a lot. How would that affect their borrowing capacity?
With expenses, that would generally be a once-off expense. So they generally would have saved up some money
for that time,
for that holiday. So they might have saved $20,000 to go on that holiday. So those expenses coming out of the account can be justified because they're not ongoing living expenses. their once-off expenses. So the expenses side of it we can cover off on as a broker, and a bank wouldn't really look into that too seriously.
So it's not going to affect it that much.
Correct. It's different if they're going on holiday every 3 months, but going overseas is something you might do once every 5 years.
Okay.
The other side of it with your income, if you're employed casual and you take 2 months off, that will affect your borrowing capacity because banks generally want
6 months
6
consistency.
months average and look at your income from there. But if you're permanent and you've taken time off without pay and you're going back to work and you're working, they'll still use your permanent income for your salary.
So do you recommend all the listeners to get a permanent position in their job? Or
Definitely. If you can get a permanent role.
And even though that might lower your hourly rate, it's better in the long term?
There are benefits of being permanent. For example, you get holiday pay, you get sick pay. But if you are casual as well, if you're consistently working in a casual role, that's fine as well because you also might want that flexibility being casual. So I can't really say one is better than the other. It comes down to how consistent your casual income is. If you, for example, work 3 months and then have 3 months off and then work 3 months, that's not in your favour to be able to borrow any money.
Yeah.
But if you're casual and you're working consistently every week, we look at the last 6 months average, then that's fine.
So I know, like myself and some of my friends, we babysit and like do some tutoring on the side to get some extra money. If it's an extra 5-10 grand a year, how would that work? Is it still an income or is it just an extra bonus?
It really comes down to your tax return. So that's really being classified as self-employed. So you might have your permanent job or your casual job and you're doing a side hustle, and it might even be a small business that you do on the side. If that income is on your tax returns and it's consistent, so generally 2 years consistency of that income, a bank will use that income for servicing. Some banks will only look at 1 year financials, but then you also need to have an ABN number registered for more than 18 months. So it really comes down to what's on your tax returns as to what income can be used. If it's cash, let's say you might get $100 every now and again for babysitting, then you can't use that income, no.
Okay. So say I was to live by myself or say I was living with someone else, how would the bank consider that with my living expenses?
Are you talking about borrowing money with somebody else and buying a house with them?
Yeah.
Okay, so if you're borrowing money with somebody else, let's say your boyfriend, looking at buying a house together, you've then got 2 incomes to go towards buying a house, which would increase your borrowing capacity quite significantly.
And then that would also increase the deposit, or?
Well, it would as well. If he's got savings as well, then you can use both your deposits to go towards that purchase. If on your living expenses, the other benefit there is if you're single, your living expenses might be, call it $1,800 per month for a single person. A couple might be $2,500. Being a couple is a lot cheaper than being 2 singles buying a house.
Yeah.
So being a couple reduces your living expenses and increases your income and increases your borrowing capacity. So there are definitely benefits in your borrowing capacity by having a partner or buying a property with a friend, because it does increase your borrowing capacity a fair bit and gets you into the property market.
So if I was able to borrow $400,000 alone, and then someone else I was wanting to buy a property with was going to borrow $400,000, does that mean we could borrow over $1 million, or
potentially close to $1 million? So you're saying 400 and 400, and then $1 million together. Potentially yes, because if you're a couple and you're in a relationship, your living expenses will be less together. If it's 2 friends, you're classified as 2 singles.
Yeah.
But if you're a couple or de facto relationship and you're buying a house together, it's living together, your living expense will be less, which means your borrowing capacity would be higher than what it would be as 2 individuals.
Okay.
So 400 and 400 individually, you could potentially borrow $1 million if you're a couple.
Would you recommend buying your first house as a single or as a couple?
I think it depends on how serious you are in that relationship as well. So it's a hard question to answer. So if you're serious with that person, you are looking at being with them long term, then definitely look at buying a house together, because it will get you into a better property.
So last on the list, liabilities. Can you talk me a little bit through that and what that means for a uni student like me?
Liabilities would include things like credit cards, afterpay, a car loan, and even HECS, unfortunately. So being at uni, you do have a HECS bill, and it is growing. So HECS is taken into consideration, and unfortunately does reduce how much you can borrow. So they're liabilities which the banks look into. The ideal scenario is to reduce your liabilities as much as possible. HECS will be a challenge, but things like credit cards and car loans and afterpays, try to avoid having any of those if you can when you are applying for a loan.
Because they're not necessity debts.
Correct. A credit card, for example, will affect how much you can borrow. Even if you've got nothing owing on that credit card, let's say you've got a $10,000 credit card limit.
It's still a
nothing
debt.
owing, there's still a $10,000 liability there. So that will affect how much you can borrow. And that could be 50 grand. $10,000 credit card could affect your borrowing capacity by $50,000. So if you can avoid having any credit cards and any personal liabilities, there are definitely benefits there. In regards to HECS, HECS is calculated based on what you're earning. So depending on how much you're earning is how much banks take off your income to allow for HECS.
And when does that HECS start getting taken off your income?
So HECS generally starts getting paid at around $54,000. So at $54,000, I think it's around 1% of your income will go towards your HECS. That percentage goes up as your income goes up. So let's just say at $65,000, it might be 2% of your income goes towards paying off your HECS debt. Unfortunately, HECS does get taken into consideration when you are borrowing money.
So if HECS is considered a liability, am I better off paying some of it off now or leaving it for when I start earning consistent money?
It really comes down to your situation, and every situation is different. There's no difference if you pay off a portion of your HECS. If you got a HECS debt, it's still taken into consideration. So whether you got a $5,000 HECS debt or a $100,000 HECS debt, the repayment is still the same.
Okay.
The way they work it out. But because everyone's situation is different, for example, you might have a large deposit, enough to be able to go towards paying off your HECS debt, but then you use that deposit towards your HECS debt, then you've got
won't
no
be able to
deposit.
have one for a house.
But then there's other ways of getting properties too, where you might be in a position where your parents can provide your security guarantee. So you might be able to increase your borrowing capacity by paying off your HECS debt with your savings, using a security guarantee for the purchase and borrowing more money. So every situation is very different, which is why it is important to speak to a broker to run through your scenario.
So what if someone was to have a car loan, like a $10,000 car loan, how would that affect their borrowing capacity?
That is an expense which gets added to your bottom line. It does affect how much you can borrow. So if you've got a car loan and repayments of $400 per month, that's $400 that's coming off your income instead of going towards increasing your borrowing capacity. So if you can, depending on your situation and what savings you do have, if you can pay off your car loan before applying for a loan, that would be the ideal scenario. But if you can't, as long as you've got enough deposit, and it comes down to what your borrowing capacity is and what your income is. So if you're earning good money and you've got a good deposit, there's no need to pay off your car loan. So it really comes down to your situation.
Would there be any difference if it was like a 3 to 5 year term or a 7 to 10 year term?
Banks would look at what the monthly repayments are and take that off the bottom line. So really, it actually benefits you if you've got a 7-year loan term, because your repayments would generally be less, which means your borrowing capacity would be higher. So if you borrowed $10,000 over 3 years as opposed to $10,000 over 7 years,
your repayments would be more in 3 years.
Correct, which would reduce how much you can borrow. So in a way, the longer the term on a car loan, if you do have to buy a car, try to keep your repayments as low as possible.
So what are the difference between the banks?
Banks will lend you different amounts of money. Every bank is different. And there are the major banks, and then there's the second-tier lenders, which you probably wouldn't have heard of. So
who are the major banks?
The major banks are Commonwealth Bank, National Australia Bank, ANZ, Westpac,
so the more
SA,
commonly heard ones.
The ones that you see branches around for. So they're probably the top 4 major banks. And second-tier lenders would be people like maybe Macquarie Bank, Suncorp, Resimac.
Indigo.
Adelaide Bank, Bendigo Bank. Yep. So they're almost major, but they're not the major banks. So second-tier lenders. So there's banks as well that have different policies which can increase your borrowing capacity. So just on the top of my head now, there are some banks that would look at your borrowing capacity over a 40-year loan term rather than a 30-year loan term, which can be very beneficial for first home buyers. Because if you're borrowing over 40 years, your repayments are less, but that also means that your borrowing capacity is higher. So there are a couple of lenders that will offer 40-year loan terms for young people.
What, are they the major banks or the
Not a major bank, no.
No, so the second-tier banks.
Yep. And the other thing with second-tier lenders, some of them have slightly different credit policies where so what happens when you borrow money, let's just say the interest rate's 6%. A bank would add 3% to that interest rate as a buffer. So you've got to prove to the bank that you can make those repayments at a 9% interest rate. Some second-tier lenders have reduced that buffer to 2%, and some even 1% too. So if that buffer, let's say it's 6% plus a 1% buffer, you've then got to show the bank that you can service the loan at 7%, which increases your borrowing capacity as well. So there's little things like that which you need to take into consideration to increase your borrowing capacity, especially when you're trying to buy your first house.
So would you recommend going for a major bank or a second-tier lender?
It all depends on your situation.
So that's where you come to someone like you, a broker, to recommend it.
Like for first home buyers, for example, not all major banks offer the government guarantee scheme. There's some second-tier lenders that are offering the government guarantee scheme.
Okay.
So
what is the most commonly used bank that you deal with for first home buyers?
I can't really answer that because everyone's situation is different. So it depends on their situation. For example, are you casual or are you permanent full-time, or do you get bonus, or do you get cash, or do you get commission? So first of all, it's your income. Which bank suits your income policy?
Yeah.
Then it's your deposit. Are you taking advantage of the government guarantee scheme? Some banks don't offer the government guarantee scheme. So it's really looking at your situation. And then on top of that as well, banks' policies are also changing. So what might be good for you today might not be good for you in 3 months' time.
So as a first home buyer, can I buy an investment property instead of a house to live in?
Definitely you can. And that's something that is very popular these days, where people are still living at home with their parents, have saved a deposit, and are buying their first property as an investment property. So the benefits of that is you are getting to the property market. In terms of your borrowing capacity also increases quite significantly, because you then can use rental income of that proposed property. So let's just say you're buying a property for $500,000. Rent's $500 per week. That's extra income that you can then use to increase your borrowing capacity.
And put it towards your deposit. Another deposit?
No, you're paying to put it towards your repayments.
Oh, okay, yeah.
So you're borrowing money to buy an investment property. That rent is helping you pay off that loan. So you're living at home with your parents, so your expenses are low. You're buying an investment property, so your borrowing capacity increases because you've got rental income coming in. And it's also a tax deduction too. So your borrowing capacity increases because of that reason too. It allows you to get into the property market and take advantage of capital growth while you're still young as well.
So around the 20-year-old mark, would you recommend buying an investment property instead of a home to live in? Because that's what I was thinking of doing.
If you have stable income, a good deposit, I would recommend buying an investment property. And if you're not looking at moving out of home soon.
But that sounds pretty good. What are the downsides?
So the downsides are, in some states, you can't buy an investment property and still be eligible for the first homeowners grant. So you might buy an investment property first, buy a house then to live in, but you won't be entitled to get the first homeowners grants. But in saying that, in some states, you can still get the first homeowners grant and have an investment property. So it's good to do your research with your appropriate revenue department, Revenue SA, for example, here in South Australia, Revenue Victoria in Victoria. Do your research to make sure if you were to buy an investment property first, would you still get the first homeowners grant?
If you were to buy a house next to live in.
Correct.
So the main things that I need to provide to a bank as a borrower are my income, my living expenses, and any liabilities that I might have.
Correct, yep. So your employment situation, your bank statements for your expenses, and your liabilities being your credit card statements, etc. So I might just touch on one more thing, Nicola, which you haven't asked about, which is your credit file. So everybody has a credit file. And on that credit file, it lists all your liabilities, and it actually tracks if you're up to date with your repayments. So let's just say you have a credit card and you miss a repayment. That actually gets reflected on your credit file, and when you do apply for a loan, the bank can see that. So it's important that if you do have any liabilities, you don't miss any repayments.
I'm up to date with all my repayments.
Correct. And if you ever get a letter in the post saying that you're in default of your loan,
that's not good.
That's not good. That could potentially affect your borrowing for a long time.
So the three main things that I need to provide to a bank as a borrower is my income and employment status.
Also, in summary, there's two main things the banks look for. First of all, it's your deposit, and then it's your borrowing capacity. So for my borrowing capacity, it's my income, expenses, and liabilities.
So there's three main things I need to provide to the bank as a borrower: my income, living expenses, and my liabilities. That's
correct, Nicola. That's so a bank can work out how much you can borrow. So in summary, in order to work out what you can buy, the two main things the banks look for is your deposit
and my borrowing capacity.
Your borrowing capacity. So looking at your income, looking at your pay slips, looking at your bank statements, and looking at your liabilities.
Well, this has been really helpful. So the next episode, what are we going to be talking about?
We're going to go into government grants, first homeowners grants, government subsidies that are available in each state around Australia.
Thank you. See you all next week.